Hey there, welcome to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. And what are we talking about today? We are talking about cryptocurrency. And today's topic is navigating uncertainty, where crypto fits in a world of tariffs and tensions. Global markets are under pressure. Rising tariffs, geopolitical tensions, and economic uncertainty have investors questioning where to turn. While traditional assets face increasing headwinds, cryptocurrency has re-emerged as a potential alternative, gaining attention as both a speculative opportunity and a long-term hedge. But where does crypto really stand in today's financial markets? And how should investors think about it in the context of the broader macro trends? In this webinar, we will break down the evolving role of digital assets like Bitcoin and Ethereum amid today's global challenges, from its reputation as digital gold to its place in institutional portfolios. You'll explore the various ways to gain exposure to cryptocurrency. And just a quick dive into our webinar outline for today. We're going to cover crypto in 2025, a macro overview of the landscape. We're going to talk about how tariffs and global tensions impact financial markets. Where does crypto fit? Digital assets as alternative investments and the different ways to gain exposure to crypto. Bitcoin as a store of value and safe haven for digital assets, and the risks and considerations for new investors. With us in the studio, we have Pranay Yadav. He's the senior research analyst for Min Finance. He has deep expertise in global macro, focusing on agriculture, metals, oil rates, FX, and digital assets. And also in the studio with us, we have Raghav Vashish. He's a research analyst with Min Finance. And Raghav has experience covering semiconductors, global macro trends, and the evolving new energy space. Okay, before we kick things off, can I just do a quick sound check? Can you hear me loud and clear? If you can, please go to the question box and type yes over there so I know you can hear me loud and clear. And if you have any questions at any point in time during this webinar, you can head to the question box and type your questions in there. We'll pick up the questions at the end of the webinar. Okay? Let me know if you can hear me loud and clear. Look for your question box. If you're on a desktop, it's somewhere on the top right. If you're on a mobile, oh, great. Thanks for confirming that you can hear me loud and clear. Thank you so much. All right. If Pranay, if you're all set to go, sorry, Raghav, you're kicking things off first. If you're all set to go, I can hand the time over to you right now. Raghav, please.
Yes, Sri, thank you so much. I hope you guys can hear me loud and clear now. Um,
Yeah, we
so,
can.
uh, right. Okay. So, good evening, everyone. Welcome to our webinar. It's called Navigating Uncertainty, where crypto fits in a world of tariffs and tensions. Really pleased to host all of you this evening. My name is Raghav, and I work as a research analyst at Mint Finance. And over the next 45 minutes, my colleague Pranay will help us navigate one big question. The question being, where exactly does crypto belong in portfolios today when things like geopolitics, tariffs, and even election cycles can change the rules overnight? So, without further ado, we'll get started with a brief introduction to Mint Finance. Um, Mint Finance is a Singapore-based boutique research and consulting firm. Our clients include exchanges, hedge funds, commodity traders, producers, and consumers. Our research blends fundamental analysis with technical and quantitative insights. So essentially, we as a company have one major craft, which is research. And our research manifests into three broad segments. We publish papers, some weekly, some monthly. We publish on themes like energy transition, AI, the changing world order, and how to navigate the equity space. As you can imagine, right, the world is going through a flux, and that has big implications on asset values, on stock prices, on commodity prices. So we write about all of those. We serve both retail and institutional investors. And in terms of education, we conduct workshops, much like this one. We also do a periodical seminar titled Navigating Global Macro, wherein we look at what's happening in the world at large and how that impacts investor portfolios. Uh, we have to also do this quick disclaimer, right? So this material that we're presenting today for you is for general educational purposes only. It does not offer any specific investment or risk management advice. So we will be presenting results, and as you all know, past results are not really indicative of future performance. We will be using examples in this webinar, which are for explanatory purposes. And since, again, what we're tackling here today is basically all based on retrospective insight. So it's always better, always prudent to do your own research in addition to what we're going to be sharing today. Right. So before we dive into today's topic, it's worth stepping back for a moment to define what we really mean by crypto assets. At a basic level, a crypto asset is a digital token that exists on a blockchain. Now, blockchain is like a digital ledger, wherein you can say that it records transactions in a secure, tamper-proof way, which is shared across a network of computers. Uh, these crypto assets can serve different purposes. Some act as stores of value in digital form. Others are used to power decentralized applications like some trading platforms. And some represent ownership or access rights within these blockchain systems. Now, what makes these assets different from the traditional digital assets is that they're not controlled by a single central entity. Instead, the rules governing these assets are written in open code. They're enforced through decentralized networks using cryptographic verification. And that's what allows them to operate outside the traditional financial intermediaries as we know them. And it is this departure from legacy systems that we'll sort of be unpacking today. And now I'll sort of be handing over to Pranay. So Pranay, you can walk us through.
Thank you, Raghav. Thank you for that intro. So, hi everyone. My name is Pranay. I'm a senior research analyst at Mint Finance, and today I'll be running this seminar, right? So, let's begin with a macro overview, breaking down everything from presidential tweets to buy programs that are now shaping digital asset prices. Let's start with some context, right? So 2023, 2024, and 2025, this has essentially been a period of chips, right? Nvidia has skyrocketed from already lofty valuations to become the world's most valuable semiconductor firm. This has all happened while it rides the whole AI wave. So the question is, why are we opening a crypto talk while with Nvidia, right? Why mention Nvidia? Well, because Nvidia is the poster child for high beta tech. Explosive growth potential paired with extreme volatility. Essentially, Bitcoin, Ethereum, and other crypto assets move in the same way, only faster. So if Nvidia is a race car, crypto is a rocket sled. And that comparison sets the stage for us. Crypto lives in the same risk quadrant as frontier tech. Over the last 5 years, Bitcoin's beta to Nasdaq and Nvidia has averaged above 2. In upswings, that amplification delights traders. However, in downswings, it can also terrify them. Yet, investors keep coming back. The question is, why, right? Well, because behind the noise, adoption is sticky. Unique wallets on blockchain networks keep rising. Venture capital in the space, though cyclical, never truly retreats. Crypto's growth line looks jagged month to month, but if you zoom out long enough, it bends pretty much entirely upwards. This trend is particularly apparent when we observe the long-term price growth of Bitcoin in the context of its halving cycles that we've marked out here. Halving cycles here represent supply-side adjustments. Essentially, they represent the amount of new Bitcoin that's produced periodically that's adjusted within these halving cycles. So that acts to consistently reduce the available new supply of Bitcoin, which acts to kind of reduce the supply and push up prices, right? So with that, we can see this long-term trend on a logarithmic scale. Bitcoin has pretty much trended straight upwards, right?
Right. Thanks for highlighting this, Pranay. But that was about just Bitcoin, right? How does that behavior sort of connect to all crypto assets as a whole?
Right, right. Thanks for that, Raghav. So yeah, I did kind of switch over instantly from crypto as a whole to Bitcoin. Why is that? Well, because Bitcoin is the primary, initial, sort of foundational crypto asset. It introduced cryptocurrencies to the world. It was the very first that was launched back in 2008, well before the space even existed. Anyone even knew what any of this meant. So it was the very first. Moreover, performance of Bitcoin is entirely correlated with how broader crypto assets perform. So when Bitcoin prices rise, crypto assets as a whole tend to rise as well. And when Bitcoin falls, all of them kind of fall in tandem as well. So they're inextricably linked, and Bitcoin kind of acts as the leader in the space. That's why in some places we will switch over from talking to crypto as a whole to Bitcoin as a proxy for the crypto space. So with that, here's a headline that I don't think any of us would have thought it would be even thinkable 5 years ago, right? The US is now considering Bitcoin and crypto for its strategic reserves. So with the addition of crypto assets to strategic reserves, it brings them to the mainstream. Now, crucially, the US is not the first here. Many other countries already use crypto assets as reserves, and others are exploring the possibility already. So first we have the nations that already hold digital assets on their balance sheet and they use them as reserves. So here we have Iran, Bhutan, El Salvador, to name a few. Next, we have some countries that are publicly studying the idea. So they've not kind of launched an official digital asset reserve yet, but they are exploring the possibility. This includes countries like Argentina, Japan, and even Russia. And finally, we have the countries that have substantial holdings of crypto assets. Now, they don't necessarily term these as strategic reserves. Initially, this includes the US as well, but now that's clearly transitioning, right? So these countries don't think of them as reserves, but they still hold large, substantial holdings. These are mostly through asset seizures, which, when we look at it now, they practically represent large reserves, right? So these can include countries like the US previously, they include China, they include India. So why does that matter? Well, because once you start treating Bitcoin like gold, it shifts from this speculative token to macro collateral. Central bank interest is reframing that whole narrative. And it's not just central banks, as you can see here. Other institutions are also adopting crypto assets. The forerunner here is MicroStrategy. MicroStrategy embodies this whole narrative shift. So they hold just by themselves 500,000 Bitcoin. So that makes them one of the largest singular holders of Bitcoin. They acquired all of these at roughly $68,000 per coin, paying a total of more than $38 billion, right? So whether you call this visionary, whether you call this reckless, the market is now essentially pricing MicroStrategy as a leveraged Bitcoin proxy. And conversely, its impact on Bitcoin prices is also very apparent. Following MicroStrategy purchases of Bitcoin, prices tend to rise. They rise by an average of 0.5% when we look back through the entire history of purchases. Over the one following day after their purchase, price tends to go up by an average of 0.5%. Now, since November 2024, that impact has been amplified. So since November 2024, or since the election cycle in the US, the average impact of MicroStrategy purchases on Bitcoin price has been an average gain of 0.8%. So it's sort of amplified now, right? Now, other institutions, they may not be holding Bitcoin on their balance sheet like MicroStrategy is, but they're also starting to invest now. And that's happened mainly through the newly launched spot ETFs in the US. So spot ETFs have sort of provided this institutional fuel to the crypto rally. Now, this chart shows us US Bitcoin spot ETFs, the net inflows into all of the combined ETFs since approval. And I have two key messages that I want to bring out here. One is that the pent up demand before the launch was very, very real. Billions poured into these spot ETFs within weeks. And they came from mainly institutions and pensions that could never touch offshore exchanges previously. And now these ETF flows are driving price. On high inflow days, Bitcoin rallies, and on large redemption days, it stalls. As you can see here, we've highlighted a few of these periods. So when there's large inflows for a continuous period, prices tend to go up. And when there's large withdrawals, as you can see here, prices tend to go down. This means that traditional market mechanics are finally within the crypto space as well. They're impacting it in a very similar way to how traditional financial assets are impacted by investor interest and especially institutional investor interest. So now we've walked you through the pros. Now I have a twist for you, right? 2025 was not just the year of AI euphoria and Bitcoin ETF flows. Trade tensions came back roaring and they came back hard. Steels, semiconductors, equities, they were all caught in the crossfire. Prices fell sharply, but they also recovered pretty rapidly once the pause was announced.
Right, so we just touched upon tariffs, right? And it was a major shock across sectors, something entirely new and unexpectedly soon for us to deal with. I mean, Trump had been talking about it throughout his campaign, but it was just too soon for us to deal with. But personally, looking into tech and semiconductors, I did see how even the market leaders in that space were hammered last month. How would you say Bitcoin handled that shock compared to, say, a firm like Nvidia?
Thank you, Raghav. That's a great question. So the answer is much, much better than you would guess. Nvidia lost nearly 12% following the Liberation Day announcement on the 2nd of April. Now, Bitcoin fell too, but it fell much less. It outperformed equities, it outperformed equity indices, both the S&P 500 and the Nasdaq 100. And on the chart, the assets that we've highlighted here, it only lagged gold during that period. Now, since then, crypto has also rallied much harder than everyone else. It's now the top performing asset since the start of April. Uh, so, of course, we should kind of be honest, right? As I mentioned, all assets fell during these kind of periods of shock. Fear hits everything, and BTC was certainly not spared, right? So on this chart on the left, what we've done is we've highlighted asset returns 1 week after Liberation Day. So those are the red bars that you see here. Then we've highlighted the asset returns on the day after the tariff pause was announced on the 9th of April. So as you can see, everything bleeds red, including Bitcoin during that initial period. However, there was that immediate rebound as well. So within that initial period of decline, as you can see, Bitcoin here outperformed the S&P 500. It outperformed Nasdaq 100 and outperformed Nvidia as well. It did lag behind gold, as I mentioned, but again, far far above equities, which is generally not to be expected, right? Now, a nuance here as well. On the day of recovery, that is the tariff pause day on the 9th of April, all the asset prices rose once again, as you can see. But here, Bitcoin rose much less than the others. So, although in the previous chart we saw that its recovery since then has been pretty strong, its recovery was more protracted. So, that is to say that it took much longer to materialize. But once it did arrive, it was kind of shooting up, right? Now, as I mentioned, it was a bit odd that Bitcoin outperformed them, and the reason behind that is that Bitcoin is a sort of a riskier asset. And now, when I'm saying riskier here, I'm using volatility as a measure of risk. So historical volatility, which is what we've plotted here, we've plotted different measures of historical volatility, both the 10-day historical volatility on the 10th of April. So that's the sort of liberation day and the tariff pause, right? Then we have the average over the past year, the maximum over the past year, and the minimum over the past year. So as you can see, Bitcoin's historical volatility, it's far higher than gold, it's far higher than S&P 500, it's far higher than even the Nasdaq 100, right? It's more closer to Nvidia, which in itself is a highly volatile instrument. Now, what that means is higher volatility does mean that there's this potential for sharper drawdowns. Although we didn't see that this time, that is a risk in general. So higher volatility assets do come with their own set of risks. So the main takeaway that I want to highlight from this tariff section is that tariffs do matter to Bitcoin. The impact was very much there, but they don't break the overall crypto story that's been in play for several years now.
Thanks, Pranay. What we've established here is that there is extremely high volatility. But given this context now, how can investors add these digital assets to their portfolio while sort of minimizing additional risk? As in, how much of their portfolio should really be allocated to crypto?
Right, great question, Raghav. And this is one that both us and other asset managers, we've all researched very deeply, right? And the answer is that crypto is best utilized as a satellite asset, which offers sort of an outsized punch to an overall portfolio. So for illustration, here's a conventionally diversified portfolio. That's the line in orange that you can see here. So the line in orange consists of 25% in the TLT ETF. So the TLT ETFs consists of long-dated US Treasuries, 25% allocated to gold, 25% to the S&P 500, and 25% to the sort of tech-heavy Nasdaq 100. Now, this portfolio has performed very well. It's appreciated by 64.8% over the past 5 years. That represents a CAGR of 10.5%, right? So 10.5 per year, it's kind of increased by. Now let's see what's happening with this blue line here. So the blue line here, what we're doing is we're adding a small allocation of BTC. So we're reducing 1% from each of those 25% to all four of them, and we're assigning that 4% to Bitcoin. So after this whole updated portfolio is 24% to all those four assets, and then 4% to Bitcoin, right? So what we get is a conventional portfolio with a Bitcoin satellite. And as you can see, the portfolio performance, which is with the blue line here, it jumps sharply, right? The portfolio, including the satellite asset, it's appreciated by 96.2% over the past 5 years. That's sharply outperforming that conventional portfolio. The CAGR, that jumps from 10.5% to 14.5%. That's a sharper outperformance. And notably, despite this outperformance on the upside, it's not significantly exposed to downside risk either. The satellite portfolio performance never really dips below the conventional portfolio's performance, as you can see on this chart here, right? So it's kind of consistently outperforming over the past 5 years. Now, of course, one nuance here, as Raghav said in the beginning, past performance, which is what's indicated here, doesn't necessarily indicate future performance or future returns. So that is a nuance that I do want to bring out even just now. But regardless, a tiny slice of Bitcoin to a portfolio offers a very big punch. Now, if you want to do a more comprehensive analysis, right, we can look at the study that was conducted by Fidelity. So Fidelity backtested multiple start dates for a 1 to 5% Bitcoin asset allocation to a 60-40 conventional portfolio, right? So 60-40 portfolio is 60% in equities, 40% in bonds. So what they decided to experiment with was a 0% allocation with Bitcoin, 1%, 3%, and then 5%, as you can see here. So what we have done here is kind of summarize the results of their study in one sentence. What was observed was that a Bitcoin allocation improved risk-adjusted returns, and that happened without a substantial increase in volatility. The max portfolio drawdown, which you can see on the far right here, was also slightly higher, but it was only impacted minimally. Now, I'll just run you through the broader results with the 5% BTC allocation, as you can see. So compared to the 60-40 portfolio allocation, a 5% Bitcoin allocation to that conventional 60-40 portfolio improves annualized returns by 4.5%. It improves Sharpe ratio by 40%. Now, on the downside, as I mentioned, it's not all roses, right? It does increase annualized volatility, but the increase is quite moderate. So the 5% Bitcoin allocation increases annualized volatility by 1.77%. And as I mentioned, of course, there is a slight increase in max drawdown. That's an increase of 1.72. But when we compare it to the overall drawdown, so for reference, the 60-40 portfolio, the max drawdown they observed was about a 22% drawdown. So with the 5% BTC allocation, that increases from say 22% to around 24%. So as you can see, the impact was definitely there, but it was quite minimal, right? Now, what I want to kind of segue into is that major institutional asset managers, pension funds, institutional funds, they're all starting to already use the strategy of small BTC allocation, like a small part of their portfolio, they are starting to assign it to Bitcoin. So BlackRock and Fidelity study, as we mentioned in the previous slide, BlackRock has also conducted a similar study to establish how much a small allocation of Bitcoin can impact the portfolio. So both of these studies have yielded positive results, and they've supported a small allocation to Bitcoin. And as you can see from the headlines on the right, pension funds have already started to execute on this allocation as well. So they've started to assign small, 1 to 5% of their portfolio towards Bitcoin and digital assets. They've already started to capitalize on this strategy, right? So crypto's seat at the institutional table, it's no longer hypothetical. It's there, right? It's reserved.
Right. So the idea is that a 4% Bitcoin allocation or a 5% Bitcoin allocation can boost portfolio returns without blowing up risk too much. But the question here is how exactly should investors go about building that exposure, right? So do you buy Bitcoin directly? Do you use an ETF? Or is there something else entirely different?
Right. Thanks, Raghav. So that's what we're getting into next, the different ways of gaining exposure, right? So essentially what we'll be describing today are the four broad avenues for gaining exposure, which is spot coins on crypto exchanges. We have ETF shares. We have crypto futures and options. Then finally, we have crypto contract for difference or CFDs. Now, each has its own pros and cons, so the choice falls entirely on what the investor is looking for. What we'll do is we'll discuss some of these benefits and drawbacks for each of them, right? So on the first slide, we'll be looking at spot cryptocurrency, which is cryptocurrency, actual cryptocurrency that you would buy from a crypto exchange, right? So the pros here, of course, the foremost here is that you directly hold that asset, which means you actually hold the cryptocurrencies, which also means that you can transfer that asset on the blockchain. So if I want to transfer my Bitcoin to another person, I can use the Bitcoin blockchain to do that if I hold that Bitcoin on the blockchain, right? Another advantage here is that there's no holding or management costs. I'm doing it all myself, and the blockchain certainly doesn't charge me any management fees as such. Another advantage is that spot cryptocurrency is generally available for trading 24/7. So, regardless of what day of the week it is, or if it's a holiday, or if it's nighttime, you can always trade cryptocurrency on crypto exchanges pretty much 24/7, right? These markets never shut down. Now, at the same time, I want to emphasize this does come with its own risks as well. It requires technical know how to set up your own crypto wallet, and setting up your own wallet does leave you open to a risk of cyber attack from hackers. Additionally, your wallet is pretty much protected using something called a private key. You can think of this as a password for your wallet. Now, in case you happen to sort of lose your private key, you lose your password, there's pretty much no way to recover your crypto asset. So once you lose your private keys, it's sort of gone forever, right? So there is custody risk associated with spot currency. That is a major sort of drawback. An alternative I want to highlight here, some people like to hold their crypto on these crypto exchanges. If you guys might remember from 2 years back, when crypto exchanges blow up, you're not getting any of your cryptocurrency back, right? So that's the whole concept of sort of custodian risk or intermediary risk that you're running into as well if you decide to hold it on a crypto exchange instead of your own wallet. Now, the next potential instrument to use here is a crypto ETF. So, as I mentioned, these are somewhat new, right? They were launched last year. So, the pros here are that your holdings are managed by the fund issuer. So, the fund issuer here, they'll be taking care of custodying your assets. So, they'll be in charge of sort of protecting it from hackers, all of that stuff. That's something that they'll take care of. Another thing, this is all regulated by the SEC in the US, and they're all listed on regulated exchanges such as NYSE, right? So they're very much regulated. And another advantage here, like I mentioned, storing crypto on crypto exchanges is risky, right? So in this case, you have very low counterparty risk. So if the NYSE is very unlikely to kind of blow up, right? So the counterparty risk argument is far, far reduced here. It's pretty much nil. Next, of course, we do have drawbacks, which are important to emphasize. The foremost here, you cannot withdraw your cryptocurrency. So as I mentioned, with the spot crypto, you can transfer it from one Bitcoin wallet to another. You can't do that with the ETF. So you can't actually take your Bitcoin out and transfer it on the Bitcoin blockchain. It's all with the asset manager. All you can do is sell your ETF share. Another thing is that you do have to pay some management fees for this. Now, these management fees, they are modest, generally around 0.1% or even below that, but they are still a material cost to using these asset vehicles. Another potential drawback, these ETFs, they're only tradable during US market hours and again, not on the weekends, right? So any move that happens outside US market hours or happens on the weekends, it does leave you potentially exposed. And finally, you have access to very limited crypto assets through ETFs because there are thousands, in fact, millions of crypto assets, right? But through ETFs, you'll only get access to a limited handful of the big ones. Next, we have crypto futures and options. So here a couple of new concepts are introduced. So first is leverage, right? So leverage allows you to place trades that are far larger than your capital availability. So in case you only have $100 with spot cryptocurrency or with the ETFs, you can only buy $100 worth of crypto. But with the futures and options, you get access to leverage. So you can place trades that are 100x leverage or whatever leverage vehicle you use, right? So you're suddenly able to place trades that are much larger than your capital availability. Additionally, you can use advanced trading strategies, be they sort of option strategies or a combination of futures and options. Those are not now allowed if you start to use crypto futures and options. Additionally, you'll get reliable settlement to spot prices at expiry with limited counterparty risk. Now, this does depend on which exchange you're trading these futures on, but if you go for the big exchanges, this is another advantage for you. Another advantage with the big exchanges is that they're regulated by the relevant agencies, so CFTC in the US, for instance. Another crucial point here, futures and options allow you to express both the long and the short view. So with spot and with the ETFs, pretty much all you could do is buy the asset and you could wait for the prices to go up and you could sell it. You can't kind of benefit if prices fall, right? You only stand to lose in that situation. But with futures and options, all of a sudden you're able to express a view on shorting these assets. So that is a potential benefit in case someone has a view that prices are expected to decline. They can express that view using futures and options. Of course, there are also drawbacks with futures and options. So generally, these come with a premium or a discount to spot prices. So the price that futures are trading at, it'll generally be at a premium or a discount to the spot price. So you'll either pay more or pay less, which could eat into your profits a little bit. Again, you'll have no underlying cryptocurrency holdings with futures and options. So in case you want to transfer your Bitcoin on chain, you won't be able to do that. And depending on which exchange you use, the futures contract may not be tradable on weekends. Next, let's get into CFDs. Now, the advantages and advantages here are somewhat similar to futures and options. You get access to leverage, similar to that, and you can express both the long and the short view. However, the drawbacks here are a bit different from futures. So first and foremost, you get much higher counterparty risk. So your counterparty risk is concentrated with the CFD writer, sorry. And more importantly, prices can deviate from these more liquid spot markets. So CFD prices can deviate quite significantly in some cases. So these are the four broad instruments. I will caveat that with this next slide. So there is another way that some investors opt for crypto exposure, and that's through proxy equities like Coinbase, which is a crypto exchange, and Strategy or MicroStrategy, the one I'd already previously described, right? So this too comes with its own risks. So broadly, you have these company-specific execution risks, so operational or management risks only associated with the company, right? So unrelated to what's happening with crypto prices. You also have leveraged and balance sheet risk. So some firms, they may be using debt to buy crypto, which is the case for MicroStrategy. So those large Bitcoin holdings that they've accumulated, most of those are kind of derived through debt. So that means that during downturns, your losses can become magnified. Another potential drawback here is that the equities prices here, they can disconnect from spot prices. So the stock performance doesn't always track BTC, ETH, or even crypto prices, right? They can sometimes be impacted by broader equity market factors. Another potential drawback, companies can issue their own shares. So as share issuance increases, it could dilute your holdings or it could kind of reduce the equity price, right? Finally, you're exposed to both crypto risk and equity market volatility. So while Bitcoin may only be impacted by what's happening in the crypto space, with these stocks, you're exposed to equity market volatility as well. So if the S&P is kind of going through a drawdown, it would impact these equities in addition to the impact from the crypto holdings that they have. So one more sort of nuance that I want to highlight here. So for MicroStrategy, right, which is one of the most popular Bitcoin proxy, people tend to use that as the sort of leveraged instrument for gaining exposure to Bitcoin. Now the drawback here is that you're paying a huge premium to obtain that leverage exposure. So compare that to what you can get through futures and option. what you're paying through this MicroStrategy holding is far, far larger. So it becomes much less cost effective a vehicle to use for that. The bottom line is if you want crypto, owning a crypto company gives you crypto risk plus corporate risk, right?
Yeah, thanks for walking us through the different mechanisms of taking crypto exposure, Pranay. But I had just the most basic question, right? I mean, what crypto asset do you think I should be investing in? Which one's the safest? And while being safe, which one is expected to yield good returns?
Great question, Raghav. So the answer here is that there is no right crypto asset, right? Each digital asset offers its own unique value proposition. It comes with its own advantages and it comes with its own risks. So it's entirely dependent on what the investor believes that that crypto asset is offering in terms of its unique value proposition, where it's kind of fitting in with the market. What's most important here is to conduct thorough due diligence, right? It's like analyzing any stock. Ask the right questions. A few of those questions for crypto assets might be how does the blockchain network activity look like, right? So, how active is the underlying blockchain network? Is anyone even using that, or is it just a token for the sake of being a token? You could assess the fundamentals. So, who is behind that crypto asset? Who is the development team? How many tokens have been issued? Are there any centralized holdings? Things like that. And perhaps the most important, right? Understand the value proposition. What problem does the crypto asset that you're looking at solve? Is there a viable market for it? Is it kind of fixing a problem that you see in the market? Does it have a good strong market fit that it'll be able to capitalize on? And that's perhaps the most important, right? Another kind of caveat that I want to definitely highlight here is to avoid scams, because if something seems suspicious in the crypto space, it very likely is. This is a risk with sort of emerging spaces, right? It comes with its own set of risks, and scams are generally thought to be a major risk in the space. What we'll do today, though, is we'll give a head-to-head to some of the top crypto assets. So here we'll be considering the big three, and through these comparisons, what we'll do is we'll later arrive at something like a crypto risk curve. But first, let's walk into the network and what each of these big three network kind of offers its users. So today we'll be looking at Bitcoin, BTC, Ethereum, ETH, or Sol or Solana, right? So I want to highlight a few key stats here. First is market cap. As you can see, Bitcoin is by far the largest here, right? It has a market cap of 2.1 trillion almost. This data, all of it is, by the way, as of yesterday, so 12th of May. So as you can see, Bitcoin's market cap is far larger than the other two. It's almost 10 times larger than Ethereum and 20 times larger than Solana. So it's definitely the biggest, right? It's two-thirds of the overall crypto market cap. At the same time, they come with different uses, right? Block time, which represents how quickly each block on the blockchain is kind of processed, that differs wildly. So Solana's block time is zero point 0.4 seconds, whereas Bitcoin can be around 10 minutes. So there's a huge differential here. Another kind of key stat I want to highlight to you is the number of daily transactions. So the daily transactions, they can be a measure of both how fast the transactions go through and how expensive these transactions are. So as you can see, I've highlighted those two as well. We have average transaction fees. So for Sol, that transaction fee is just zero point 0.3 cents, right? So that's 0.3 cent for each transaction, regardless of how large a transaction it is. So you could be transferring $1 million, or you could be transferring $1. You'll only have to pay zero point 0.3 flat dollars for fees. For Bitcoin, you might have to pay $1.6. For ETH, you might pay $1.2. Now, crucially, these fees do change. They're constantly dynamic. They're impacted by how much network activity there is on the blockchain network. So they are kind of always in flux. Another thing is the throughput, right? So the throughput is how many transactions are going through each second. On Solana, that's more than 1,100, nearly 1,200 transactions each second they're going through. On Ethereum, that's about 15 transactions a second, so much, much less, right? And on Bitcoin, that's as low as 3 transactions a second. So the net result of all of that is the daily transaction that's happening on each of the networks, right? So since transactions are so cheap and fast on Solana, there's a whole bunch of them happening. So that's 53 million transactions. Whereas for Bitcoin, where transactions are somewhat more expensive and throughput is a little bit slow, people like to centralize it, right? They do one big transaction instead of a bunch of small ones. And that means there's only about 282K transactions over the past, and that's a 7-day average about. Another important stat I want to highlight is the DeFi system, DeFi ecosystem value, right? So this is how much real world assets or crypto assets are available on the blockchain. So each of these blockchain, it has some sort of real world asset or it has some sort of crypto assets stored on the network. So how much is that? That also is a spectrum here. So Bitcoin has the lowest here. Now the nuance I want to highlight here is that the reason Bitcoin's ecosystem TVL is so low is that first of all, there's very little DeFi on Bitcoin. It's mostly just a sort of exchange network, right? It's mostly people exchanging Bitcoin with each other. And the other key nuance there is that while on the other networks, people might want to exchange US dollars in the form of, say, stable coins. On Bitcoin, they'll just directly be kind of trading their Bitcoin with each other, right? They'll just be directly transferring Bitcoin. So Bitcoin itself is the store of value on the Bitcoin network. So this ecosystem TVL may seem small, but you have to consider that there is this 2 trillion market cap and people are essentially just transferring Bitcoin to each other on that network instead of the whole DeFi thing. Now, the other comparison is between Sol and ETH. So ETH, as you can see, is the biggest here, right? It's currently the hub of DeFi. So most of the DeFi is concentrated on Ethereum. That's nearly $63 billion of total value. For Solana, that's about 10 billion. So much smaller. It is somewhat new, right? And similarly, similarly, there's stablecoin supply, which we've highlighted down there. But another useful stat I want to highlight to you is inflation rate, because this directly leads to the whole financial token aspect of it, right? Inflation rate is inextricably linked with how the financial token is going to be performing. So it's crucial that we look at that. So Bitcoin's inflation rate is about 1.7% annually. Now, the key nuance here, what I highlighted right at the beginning of the presentation, there's these halving cycles, right? So over time, Bitcoin's inflation rate is falling. It falls predictably, so it'll halve every 4 years. So in roughly 3 years, that inflation rate will drop from 1.7% to 0.8% roughly, right? So it's going down over time. Solana's inflation rate is pretty high. It's 4.5%, so it's inflating at a pretty high rate. That does have a sort of impact on pushing down prices. Finally, we have Ethereum. So Ethereum did used to inflate, but now it's deflationary. So depending on how much network activity there is, that means how much fees are paid to each other. There can be situations where the network becomes deflationary. That means the supply actually declines. That again can act to push up prices for you, right? And finally, the last thing I have in this table is nodes. So nodes, again, you can see is a spectrum, right? And that should give you an idea of how centralized each of these assets are. So while these blockchains, the actual blockchain networks offer their own different use cases, the tokens, they're also behaving very differently. Let's get into the tokens, right? Because as financial investors, tokens might be what's most important to us. So we can visualize all of this through what I've created here, which is the sort of crypto risk curve you can think of. So the visual here is ranking Bitcoin's historical volatility along with that of the other two crypto assets. Now, this is meant to define how risky or volatile each is. As you can see, Bitcoin's volatility, despite being higher than the equities that we viewed initially, is still far lower than both Ethereum and Solana. So that means it's relatively less risky in a financial sense compared to the other two. Now, this is particularly useful during vol spikes. I've highlighted one of them for you on the screen, but you can view some of the others too, the others here as well, right? So here the differences are becoming exaggerated. So during these periods of vol spike, the vol differences can become even larger. Now that's potentially pretty risky. So that's what we'll be looking at next. So what we're looking at next is these periods of risk, right? These periods of risk off sentiment. And during these periods of risk off sentiments, Bitcoin tends to fare a little bit better than Ethereum and Solana.
Pranay, sorry to butt in just here, but I'd like to nudge you to just break this down briefly because I think there's a lot going on this chart, right? We have two different charts, so if you can sort of just break this down a little.
Of course, certainly, yes. So what you see on the top of the chart, there are three lines, right? In the orange, we have Bitcoin's price performance. In pink, we have Solana, and in blue, we have Ethereum. So this is relative performance to each other since over the past year, so since May 2024, right? How much percentage-wise has each grown? At the bottom, what you're seeing is VIX. So VIX is often thought of as the risk gauge of equity markets. So VIX, whenever VIX spikes, You can essentially think of that as there being a lot of risk out there. So investors express that through options sometimes, and that options activity is captured through the VIX index. So whenever the VIX index is spiking, as you can see in these three locations that I've highlighted, there is some sort of risk event happening. There's some sort of market risk that's potentially taking place. And what we've done is we've highlighted the price performance during these period, and we've also tabulated it. So within these tables, what you can see is that although during these periods of market risk, Bitcoin does fall like the other two assets, it falls much less. So for instance, here, Bitcoin only fell 19%, whereas Solana fell almost 29%. Now, all of that comes down to what we described in the previous slide, which was the historical volatility, right? So historical volatility, lower historical volatility rather, helps in this situation because lower volatility means that Bitcoin is going to fall less than the other two. So essentially, during risk-off environments, savvy crypto investors, they may want to shift their holdings towards Bitcoin. So if you're seeing some sort of risk event kind of taking place, you might want to, if you're within crypto, you might want to centralize all of your holdings into Bitcoin and shift, say, away from Solana, right? And similarly, what we can do is we can look at how these assets perform during rallies. So in this chart, we've highlighted key crypto rallies over the past year. So same chart, same lines, right? Orange is Bitcoin, pink is Solana. Now in the rallies, what we're seeing is something completely different. Solana is outperforming sharply during these rallies. So when risk appetite is roaring, think meme stock season, right? During these rallies, the high beta or the high volatility Solana performs the best and it offers magnified upside. Still, there are these periods when either Bitcoin or Ethereum may outperform the flat volatility driven increase of Solana due to some idiosyncratic factor that may be taking place on each of the assets. So in this case, I've highlighted the one that's here in sort of May last year when ETTFs led to ETH rising more than Solana, right? So idiosyncratic factors can occur, but generally that higher volatility during these rallies means that you want to go towards the higher volatility instruments. Essentially, Bitcoin for defense, Sol for offense. That's one way to build a barbell inside crypto, right? Another crucial point, by the way, before we move on, these past two slides, what we've highlighted here is again past performance. And I want to emphasize that past performance is not always indicative of future returns.
Thanks for that nudge, Pranay. And thanks for delineating how to position ourselves both for upsides and the downsides. But focusing more on the latter, what are some of the intrinsic risks that new investors should be factoring in when they're just about starting to get invested in crypto?
Right, really important question, Raghav, because there are plenty of risks to investing in crypto. First of all, this roller coaster graphic says it all, right? 10% daily moves are table stakes. During drawdowns, Bitcoin has lost more than 80% of its peak values in the past. For instance, back in 2018, Bitcoin fell 83% from its peak. And then in 2022, it fell 75%. So investing in crypto is clearly not for the faint-hearted, right? The usual investing mantra does apply here. Only invest what you're willing to lose. Another material risk that's very crucial to highlight is regulation. So crypto is a particularly hot topic for regulators, and opinions are very divided. So while the Trump administration, as we highlighted in that very first slide, they've taken a very friendly stance towards the industry. This is not guaranteed, right? The regulation pendulum may swing back to the other side. So, as we've described, a few periods of heavy regulation within the industry. So, past governments, including the Biden administration, which was previously in power in the US, they've taken a very strict stance against crypto assets. So, previously, FDIC has sent pause letters to halt crypto initiatives by banks in the US. SEC has initiated litigation towards targeting exchanges, devs, stablecoin issuers, all of that, right? Crypto friendly banks have been shuttered. Other nations, of course, have also been very strict on crypto regulation. This includes ECB, which is somewhat reluctant towards crypto assets. There's also China and India. Both of them are still pretty hesitant on it. So although this US is now sort of favorable, is a favorable regulatory environment, there is this risk, right? Could the pendulum swing back?
Right, so you did touch upon things like scams as well. And keeping the previous slide aside, is there any tool that crypto pros uh, use to account for just the basic fundamental risks so that they can minimize them at their own front?
Great question, Raghav, again. So crypto offers radical transparency, so it's helpful to make use of it. At the end of this webinar, we've kind of opted to highlight a few tools that we find useful. Full transparency, we are in no way affiliated with these companies. So these are just tools that we have previously found useful ourselves in our own research. In case you see the same value, feel free to use them, right, in your own due diligence checklist. But do want to emphasize, we are in no way affiliated with these companies. So the first tool that we want to highlight is Token Terminal. This one lets you view fundraisers for crypto projects. So essentially, which VCs are backing them, right? You get to see who's backing this new crypto blockchain, for instance. You also get to view on-chain metrics. You get to view how active the blockchains actually are, whether they have any real users, and you also get to see what the ecosystem for each chain looks like. Another great tool we've seen in the past, we've used in the past, is Dune. So Dune dashboards, these are entirely created by users. So it's a user-generated content here. So essentially, they're all crypto natives. They generate these dashboards by themselves, and they curate the metrics that they personally find useful. So as a result, these dashboards can be highly customizable and really relevant for investors who are looking for an edge similar to what the crypto pros have. These are crypto natives, right? They know what they're doing, they know what to look for, and the dashboards or the metrics they curate for you, they're generally very relevant for observers that may not be familiar with the space. You can also do is you can also use the Dune API to make your own dashboards if you start to get more familiar with the space. Another tool we want to highlight is Arkham. So Arkham lets you view large holders of crypto assets and when they move their token. So this is crucial, right? This is because this is letting you anticipate when insiders may be selling. So a couple of the views that I have added here are Mt. Gox. So Mt. Gox was this Bitcoin exchange way back when, right? 2013, 2014. It was hacked and then they recovered the Bitcoin. And now there's this whole kind of payback happening where they're paying back all their previous customers with those assets. So that means they're paying back a lot of Bitcoin, almost $5 billion in Bitcoin. And that means that when that payout happens, there's potential selling pressure on the horizon, right? As people receive their Bitcoin, they may opt to sell it. So Mt. Gox wallets, people might want to watch them to see when those transfers are happening. Whenever there's a transfer, you might want to kind of preempt that, right? You might see a big sell move coming and you might want to preempt that. Another important view is Bitcoin miner wallets. So Bitcoin miners are the sort of they're essentially the network security, right? They're the ones who provide security to the Bitcoin network, and in return for providing that security, they are paid in rewards of Bitcoin. So Bitcoin miners, these are large companies at this point. They oftentimes earn a large amount of Bitcoin, and their wallets can be a useful source to track as well, because when Bitcoin miners are selling, there's potential selling pressure, right? It's essentially supply and demand. Uh, these Bitcoin miners, they're usually the sellers in most situations. So their wallets, again, they're very useful to watch. So essentially, Arkham can let you preempt this large market activity and preempt these sharp market moves and preempt these sharp price moves and kind of get ahead of it all, right? Be a pro investor in this case. Finally, in crypto, everything is on the blockchain. That includes holding, that includes wallet balances. So what you can do is you can use this final tool that we've highlighted here, Glassnode, to view actionable metrics from the blockchain itself. So this can include how active wallets are, so how active they've been, how much they've been transacting with each other. It could also be used to differentiate between who long-term holders are and who short-term holders are. So who's just in it for a week, right? Who just got their crypto assets versus whose wallet has kind of held this for 5 years, whose wallet has held this for 10 years. When the latter is selling, when these long-term holders are selling, it may be a much stronger signal than compared to these sort of short-term traders, right? So to sum it all up, crypto transparency is radical, and it's really crucial that you guys use it. Okay, so to sum it all up, this is our conclusion slide, right? So what we began with, crypto mirrors frontier tech. Think NVIDIA, but on steroids. It also has its own macro drivers, though, crucial that you watch those. Institutional adoption has been one of those recent macro drivers for crypto assets, and especially Bitcoin, with the launch of these spot ETFs in the US. Also, firms are starting to add Bitcoin to their balance sheets and also their portfolios. Tariffs did bruise the crypto story, but since that shock, crypto has rallied strongly, right? It's much higher than all the other assets that we compared it to, including gold, by the way, which is on its own separate run. The next thing we covered was that a small allocation of crypto assets can meaningfully shift the portfolio math. It can provide enhanced risk adjusted returns with minimal increase in volatility and downside. We also highlighted that exposure routes vary. There's spot crypto, there's ETFs, there's futures and options, there's CFDs. Each has its own advantages and disadvantages. It's up to what the trader is looking for, right? We also walked through a few key crypto assets. As we mentioned, there's no right crypto asset as such. It really depends on what you believe the unique value proposition is. But we walked through the big three, right? Bitcoin, Ethereum, and Solana. We highlighted what their unique value proposition was and how they behaved relative to each other. We also kind of introduced this idea of a crypto risk curve. So, what to do when there's a potential for a drawdown or risk in the market, and what to do when there's a huge rally happening, right? So, in case there's a risk, you might want to move to the slightly safer Bitcoins, the safe haven within the crypto space. And when there's a huge rally happening, go for that high beta instrument like Solana to get maximum upside. Finally, we did say that investing in crypto comes with many risks. Volatility in policy is just a couple that we highlighted, but there are other. Still, crypto also offers radical transparency, which can be used to minimize some of these risks. So it's crucial that informed investors really make use of that transparency, because in traditional financial markets you really can't get this level of transparency. You can't see who is moving things when, right? If you see something, it's usually days or weeks later. But on crypto, it's all real time. You get to see it as it's happening. That's this unique aspect that I think informed investors really need to make a use of. So with that, I think we're at the end of our webinar. I'll leave the floor open to any questions that there might be. And I also want to thank you for your time today.
All right, thank you so much, Pranay and Raghav. All right, so we have a few questions. I'm just going to do a quick fire round. I understand we are running very close to the end of the session. Okay, so my question ties in very much with the first question. Bitcoin has been around since 2009. 16 years is a long time. Do you foresee crypto going full mainstream, or will it continue to remain an exotic asset class? I mean, it ties into this other question which I have. Basically, where are we now? Like, is crypto? Does crypto have to be part of our portfolio now? Do we have to know crypto? What are your thoughts on this?
Right. So great question. I think some of our presentation touched on it briefly, but to answer it in brief, right? Crypto is starting to make its way into the mainstream, but is still very much at that inflection point. That whole mainstream shift hasn't exactly happened, hasn't materialized fully, but it's in the process now. So ETFs have led to institutions really starting to add it to their portfolio. There are a few very interesting stats, like how many institutional investors have now started to hold ETFs, right? 70% of the spot ETFs, the spot Bitcoin ETFs, they're held entirely by institutional investors. So institutions have started to come into this because they're slightly more experienced in how to manage the additional risk that comes with that volatility. Retail investors, that's a smaller class, and they're somewhat split in two groups. So there's the crypto natives, they're very familiar with the space and they've really embraced it, right? But there's the regular sort of conventional investors that have not jumped into it in a very large way as such. But through these kind of small portfolio allocations, they can improve their overall portfolio allocations. They can improve their overall portfolio returns sharply, right? As we highlighted, the results are, they speak for themselves, at least historically. So that is a potential use case here, is that small allocation to gain the upside. So at the moment, it does remain that somewhat exotic or alternative asset class, but that shift is happening, and that inflection point is being led by some of these big institutions, especially BlackRock, right? BlackRock has really believes in the space and they're really pushing for it hard.
Okay, Pranay, since we are talking about alternative assets, how about alternative coins? All right. So you covered Bitcoin, Ethereum, and Solana. How about the many other alternative coins out there? How should we, average layman investors or regular investors, how should we think about them?
Right. So I think the mantra here is, think of it like you're picking a stock, right? It's no different than that, really. The crucial investor that the crucial answer that any investor should have in their mind, that should be clear to them, is what is the unique value proposition for this coin? So for some of these crypto assets, that unique value proposition is very clear, right? Bitcoin is that store of value in the crypto space. Ethereum currently is that hub of DeFi. Solana, very fast transactions. So when you're looking at a new crypto asset, for instance, what you need to be able to answer is there that market fit for something? Is it solving a real problem, right in the market? Is there ample sort of demand for that sort of product to exist in the space? And finally, look into who is actually using the network, because oftentimes crypto token prices really shoot up, right? They kind of go on these huge rallies. They increase 1,000, 2,000%. But when you really look at who's using the network, you'll see that there's not much happening. And crypto pros tend to really watch that and stay away from that. So if a blockchain network, for instance, has a huge valuation, but nobody is actually using the underlying network, that's a huge red flag. So first thing to look at is it solving a problem? Is it addressing a real world issue? Does it have a clear market fit? And second of all, is someone actually using the underlying crypto blockchain network, right? Is it just the token that's rising in value, or is the ecosystem also growing alongside that token?
All right, looks like that's all the time we have today. Thank you so much, Pranay and Raghav. I have a few more questions on hand. I'll rest assured that I'll send it to our speakers so we can have some short answers from them, and then we'll send the answers to the audience. Thank you so much for joining us today in our follow-up email. Okay, so do look out for our follow-up email, and then we'll also send a link to the video recording so you can catch up on what was covered today. It could be a new asset class. It could take us a while to understand everything about it. So be sure to follow the link to revise what we have covered today. Thank you so much, Raghav, as well as Pranay from Min Finance. And thank you for being a wonderful audience tonight.
Thank you, Sri. Thanks,
Thanks,
everyone.
everyone. Thanks, Reed.